Howdy, Jacob here. Today we're looking at Build-A-Bear Workshop, ticker symbol BBW. We see that they're in the specialty retail industry, fairly small company at 324 million market cap, 299 enterprise value. They've been around since 1997. I feel like I remember as a kid going and making a little bear. That's cool. Um, 7% held by insiders. That's okay. Uh, Double digit is preferred, but really just any insider ownership means that um, the board and management is hopefully going to do what's truly best for the shareholders since they have stake in the business. Somewhat cyclical business in the fact that we see negative earnings, being positive at $1.59 earnings per share, down to negative $1.23, down to negative $1.54, up to $3. So on a PE basis, it looks cheap, but maybe it's because similar to, I feel like I looked at Crocs recently and it was the same story where their PE looked extremely cheap, but it was because their earnings were higher than they've ever been. And so if you were to take an average on a 5-year basis, maybe it would didn't look so attractive. But the income statement, shares are down, which is good. Hopefully, that means that, hopefully they're buying back cheap shares. And balance sheet looks great. 59 million in capital leases, no short-term debt, no long-term debt. 42 million cash on hand. So very healthy there. Cash flow statement. Okay, so capital expenditures are pretty much averaging low double digits, and cash from operations um, high teens and stuff. So I do like that their cash flow is more positive than their income statement, and it's not necessarily due to stock-based compensation. So that's good because a lot of the time, some companies can have just great cash flow statements just because they're issuing a barbarian amount of shares through stock-based compensation, but we're not seeing that here. So that's pretty good. That their free cash flow margin is higher than their earnings margin. The use of cash looks like they do pay one-time dividends because they don't have quarterly dividends, but they do have one-time payments, likely depending on how good their operations are. And then they do buy back shares. Okay. So that's not bad. I mean, yeah, they have a very high, or it looks like they have a very high return on invested capital now. But again, cyclical business, so you take an average, maybe it's hopefully above their weighted average cost of capital. But for reinvestment purposes, maybe they don't really have other places to invest in. You don't want them making acquisitions or just investing in places just to invest. You want it to be for efficiency purposes. And so just be buying back shares that are hopefully really cheap. I don't mind that. Let's make some assumptions here. So I would say that on revenue growth standpoint, went from 379 down to 337, all the way down to 255 post COVID, but is up heavily recently, and it's not due to acquisitions, so that's kind of interesting. I would say that maybe 1% growth, 12 future P and price free cash flow because it's not a big business. I mean, it's very niche. I mean, maybe I'm just biased on like what they do, but like I'm pretty sure you literally just go there to build a bear. So very niche. I mean, I could see how birthday parties and stuff would be had there and stuff, but they already are. So I'm wondering how they would increase business. As for margins, I'll really just be doing pretty close to averages here. Maybe 3%, 4%. Maybe, yeah, let's keep that. Share change minus 1%. Okay. So again, when you look at it as more of an average, it doesn't look as attractive. If you understand the business immensely, though, and you think that there's a high probability that these margins could stick at 10% and they could likely grow, maybe more in line with inflation or beyond, then it could probably be a buy. But for me and my conservatism, I just don't see it being the case right now. And I'm just going to be waiting. So thank you and have a great rest of your day.